reprice to the high or low of these levels, as it encroaches, it's most likely to refer to the midpoint of the gap or inefficiency than the extreme high or the low. And that's the basis of why we like to see, if we're bearish, we want to see the upper end of the inefficiency or gap respected and treated as a premium and not be dug into. Meaning, as I mentioned before we took our break, we don't want to see the high end of any inefficiency be retraded to if we're bearish. If the market is really, in fact, in a sell model, the best ones, the strongest delivering obvious runners, will always have this signature hallmark part to it where the upper portion of it doesn't get traded to. Look at the bodies of the candles. We have just a little bit of movement above it here, but look at these right there, right on that midpoint of that. You think that's random? When I talked about it on the 13th of June in that live stream, I said, I want to see, does this show signatures in price action that confirms, it suggests that my assumptions, by anticipating this level that's shaded in a pale orange, that would be treated as resistance or a means of beginning short trades for smart money. And in targeting this level down here, which is the bullish order block on the daily chart. So in your mind, as a trader going forward, whenever I say things like that, or I say, I'm looking at this as a premium array, I want to see it be treated as a resistance and then enter a sell program, and I point to where I think it's going to go. Right away, in your mind, you start thinking, okay, he just told me where he believes with 30 years of experience, where it's likely to go. So I just told you bias. I cut through all the bullshit. I got right to the point. If I sat down with you and taught you every single week what I'm doing, you like, first of all, I would never get that. We're still in dollar. We just finally made our way into the 15-minute chart. It does not take you this long to do the analysis, but it does take me this long, and as long as it's going to take today, for me to teach you what it is that's going on in my mind to make the decisions to tell you before it happens, and it happens in your chart later on perfectly. You want to know. You show up. You want to ask me these questions, and I'm giving you the answers. Don't bitch at how long it takes me to give it to you, because it's not an easy, and then you get the information. Like, you have to weigh out a lot of things, which it's not an easy 1, 2, 3 program. There is no easy 1, 2, 3 precision out there outside of this. There's things you can make money with, but you're never going to come to the conclusion that I'm showing you as consistent as I am with anything else. This is the market. So when you hear me talk about in a tweet, a Twitter space, or if I share the analysis on a presentation, whether it be live streamed or a recorded review, and I give you an opinion about what I think it's going to do next, that's the time when you start paying attention the most. Okay? You want to say, all right, he anticipates me, ICT's, telling you that we're expecting to see this area that's shaded be treated as an inception of a down move. And terminus, the end of the move, the low-hanging fruit, that's all I'm stating when I say that. It doesn't mean it's the end of the line. It can't go any further than that. No, I'm telling you how to frame a setup. Every element that makes up a trade has to have several factors. It's the inception of a move, where it begins, but by itself, there has to be some narrative, reason why that trade should even form, which is what I've spent all this time thus far explaining why we're seeing what we're seeing in the chart right now, which is what I outlined and told you was going to happen on the 13th of June. You look for, in time periods of the day where I teach you as kill zones, London, 2 o'clock to 5 o'clock in the morning, New York local time. If we have a bias, okay, for the number crunchers out there, if we have a bias that is indicating that the market is likely to expand lower on the weekly chart, that means the candle's going to expand down. Right away, 80% of your bias problem has already been solved by itself with that alone. But you have to wait for all the calendar events to either support or negate the idea. So we had a series of big news events, big news drivers this week. FOMC, CPI, all those things you watched me and showed you how to navigate them. Not to trade ahead of them, but after you see that information come into the marketplace and all the sentiment shift that they create. We're not looking at the data. We're not seeing what the raw number suggests. I could care less. I never look at that stuff, folks. It's never a factor. But I'm anticipating the medium or high impact news driver to create and present volatility. And in that volatility, we're looking for where does the stops rest after that first initial move? Where do stop losses reside? Above old highs or below old lows? Where are those highs and lows? We don't know where they're going to form before CPI. We don't know where they're going to form before FOMC does its first move. We don't know where non-farm payroll is going to use the high and low that it creates after the initial run at 8:30 when that news driver comes out, which is the reason why I tell you as my students, don't trade those. You don't know what you're doing. I don't know what they're going to do. They could manually intervene and send these things wherever. That's gambling. I'm not gambling. I'm not trying to inspire any of you to try to throw darts and see if you can get a bullseye where there's no skill involved. That's happenstance if you make money, but mostly you're going to lose. So what we do is we wait for that initial manipulation to come into the marketplace that you can schedule and set your watch to, and it's all on the economic calendar. The economic calendar is going to tell you the time of these reports that are coming out. The market is not moving because of the report, period. Okay? That data, it's in an envelope somewhere, okay? Weeks in advance. You think that the people, the powers that be that really are greedy, you think that they're waiting around for that same amount of information that everybody else is getting? No. No. So all of this is a lie. It's a myth to believe that fundamentals can be timed on a report release. That report being released is a smokescreen. And they're always going to use these as a justification for, okay, the market reacted to this data when it works in the favor they try to say it is. But when it doesn't, they always say, well, the market priced it in. And I was mentioning that before we went into our break. So when I tell you where I think the market's going to react, okay, that's a key point of reference in either the market I'm talking about or a specific time frame. So we were working with the daily chart, which is where most of your decision making for either a day trade, a short-term trade, or whatever, the bias is derived from the weekly chart and where it's likely to draw to. That's it. Then you're moving on to the daily chart. And the daily chart is you're watching and monitoring how each individual daily candle forms. If you're bearish, as we've been expecting since the 13th of this week, we want to see how does price gravitate to this level down here, which is that bullish order block. So each individual day, we have to weigh out, does it run into that shaded area up here, which is what I outlined is we want to see, does the algorithm offer price there? And if it does, once it enters it, at what time of day? Well, what market are we looking at? Dollar. So primary interest is nailing down the high of the day. Where is the high of the day going to form in a market that is trading at a level we expect the price to react to? So we're expecting the inception of a down move between one of three levels in here, right? No. Midpoint or the low of that shaded area. Remember what I said. If we're bearish, every inefficiency, if we're going to use it as a basis or a framework for a trade, we want to see in a premium array that's going to be used to sell off and send price lower, we don't want the upper portion to be respected. Because if it doesn't get up there, like we're seeing right here, that's really indicating that this is going to be a strong probability. For what? The trade down to and through that order block. Time of day now, okay? Got this fancy kill zone indicator right here. I draw with my annotations out, folks, by hand. I know that you like to have these little gizmos that do it, but nothing beats high touch over high tech. It makes it more meaningful to you. It's like meditation for me, and it's a little tedious sometimes when I have to do a whole lot of annotations, but when my heart's in it like this, I don't mind doing it. So here's London Open, and we're dealing with the dollar index. And I mentioned on the 13th that we would want to see the price of dollar go up into this shaded area, which is the old inversion fair value gap on the weekly chart. So we've taken that weekly chart fair value gap and transposed it to all time frames lower than it. So that way, whatever annotations you put on your weekly chart, you want to make sure that you show that annotation on all time frames. And how do you do that? You highlight the array that you're annotating on your weekly chart, and then current interval and below, or all intervals is basically the same thing. Then you'll see it on every time frame when you go through your higher time frame weekly, daily, 4-hour, 8-hour, 15-minute chart, 30-second chart. It'll always be there. Okay. Inside this window of time that begins at the left side of that London Open Kill Zone annotation box to the right side, in this area is when the trade begins, when the shift in market structure will occur, when the high of the day forms. 70% you have a probability that the high of the day will form between 2 o'clock in the morning and 5 o'clock in the morning, New York local time. But you have to have the other ingredients. You can't just simply say, okay, highs and lows, let's run some numbers and calculate, does the high of the day form on 2 o'clock to 5 o'clock on this day, this day, this day? No, you have to have the narrative in mind. And I gave it to you on the 13th. I told you what to use, this shaded area. My longer term students to know that if we're bearish, we don't want to see all of the inefficiency respected, which is a breakaway gap if it's a fair value gap. But we've already worked inside this range already. But now we're treating it as a resistance. That means it can trade up to the low and reject and go lower, or we permit our analysis to see price trade up into the midpoint, which is consequent encroachment right here. So I'm going to take that level off. Here we go. So when we're trading at consequent encroachment here, and it's in London Open, we bump the high. We want to see price do what? Showing willingness to want to go lower. Does it sharply leave once it trades up in here, hits the buy side here, and then all of this back and forth movement that I'm showing you right here, all this here, price is spending time in that range. Is it efficiently delivered? Yes. Why? Because it's moved up, down, up, but it's only keying off of the levels I told you to focus on inside that shaded area. Consequent encroachment. We want to see, does it reject after bumping the high here? Yes. Once it leaves that shaded area, how did it leave it? Energetically? Yes. So now, enter model 2022. Buy side taken here. Shift in market structure there. Fair value gap there. I know. Corners of your mouth is hurting now. It's funny, isn't it? How this stuff just keeps randomly happening. All right, so we have our shift in market structure. We have our fair value gap. And then over here, what is this? What time of day is that? 8 a.m. So you're in the heart of what? New York Open Kill Zone. 7 o'clock to 9 o'clock. That's your little sweet spot. Your setup is going to form for continuation. You hold down Control and drag, by the way, in case you want to know. I learned that from my students. All right, 7 o'clock. It can be left at 10 o'clock, but I'm going to show you the, oops, don't want to do that. A.m. And this is New York. Okay, so inside this little window of opportunity here, you're focusing on what? We've already worked up inside that consequent encroachment here. We've already seen the evidence that it wants to reject that. We have a shift in market structure. We have a fair value gap. And the market rallies up into what? Time of day. That's when the move's going to happen. New York local time, 7 o'clock in the morning to 9 o'clock in the morning. That's your New York Open ICT kill zone. This is the London Open kill zone. This is your premium array. The range is from this high down to that low. That's the lowest low. Here's 50%. A premium is at or higher than that. Does that fair value gap qualify as a premium array relative to that high and that low? Yes. Is price returning back up to that shaded area? Yes. Where specifically? The low end of it. It doesn't need to go back up to consequent encroachment. Oh. Consequent encroachment. It showed the signature that we would look for. It left the upper portion untraded too, again. Worked off the low of that gap. If you don't have these levels on your chart, or have them at least annotated in your notes that you're referring to throughout the day, in the beginning, you want to definitely have them in your chart because it's going to take you some time to get used to seeing the market like this. But over years and years of time doing it, you'll be able to work off of a notepad and you won't have anything on your chart at all. It'll be a naked chart and it's okay. But it takes experience to do that. Okay, and obviously you can see how quickly, if you're not organized, you can get really, really lost working from one higher time frame down to the lower time frame. But by having the higher time frame logic and all these reference points in mind, suddenly these mystifying moves that come out of nowhere for you, and you don't know where it came from, and everybody's on social media saying, what the hell just happened? Where'd that come from? We don't have that here. You know, in this community, we come across as arrogant and many times as narcissistic because we know what the fuck we're doing. We know exactly what we're looking for. We know exactly how it's going to form, when it's going to form. And when we take it down and we share it with our tribe, the people on the outside, they get pissed off. They think, oh, they think their shit doesn't stink around here. Well, it doesn't, baby. It smells like roses and chocolate chip fucking cookies fresh from the oven. Whether you like it or not, I don't care. You don't have to stay here. But this stuff repeats every single week. Every single week it happens. Every single week. Now, every single day is not the same in terms of opportunity. Sometimes you'll see setups that are much more favorable than like we're seeing in lesser volatile days. But when we anticipate a direction in the marketplace and it's derived from a higher time frame weekly chart using the logic that I teach my students, that I've been teaching now publicly on the YouTube channel, it gives you the framework for one shot, one kill setups where you can get in and take a lion's portion of the weekly range out. It doesn't mean you're trying to get the entire weekly range. It just means that you need a small piece of it that will satisfy you. And if you consider like a chicken bone, I use this analogy a lot. Do you eat the small little scraps on the ends of a chicken bone? I mean, if you're really a fan of chicken, I guess you do. But when I ate it, I just took the meat on the one thicker end of it, and then sometimes there'd be something left on the bone. But I'm taking the majority of it off. I'm not worrying about starting the eating process at the end of the bone, regardless of what end it is. So I'm looking for where the meat of the move is. And my concepts have been aimed at trying to get you to where the meat is. But you don't need the highest high and the lowest low, but I teach you how to find that too. So if you want to nitpick and get in like you're eating crabs and dig into all the little crevices and nooks and crannies to get every little morsel out, that's what my mentorship does. It's for freaks that want to be like that. I'm a freak. I like to know everything. I like to be in everything. I'm a control freak. I want to know everything. I want to know why it's going to happen, when it's going to happen, when is it going to fail, how will it fail? And because I know those things, I know when not to tread in the marketplace. I know when not to touch the marketplace. That's what makes me consistent. That's what makes me better than everybody else out there, because nobody else has spent any sufficient time trying to define where they're likely to fail, because they're so focused on trying to find how they can be better and right and profitable all the time, and think that it's limited to whatever their stop loss is and that's all they need. No, I want to know when the market can trick me. Even with my content, there are times that if I don't know by experience, and I had to learn this, with decades, there are times that even though I believe that my analysis concepts are superior to everything and everything that ever will exist, because it is the market, it's tied into the algorithm. I can, as the operator, you as the operator, you as the user, you will read into price like a Rorschach, an ink blot. You'll see something that you want to see. And many times social media will cultivate that atmosphere where you get mad, you get jealous, you can get competitive, you can get offended by somebody, or I'm going to show him, I'm going to show her, or I didn't do as good as that person, let me just try to outdo them. And you go in and you try to find something as a reason to get into a trade. We don't do that here. We do not do that here. You have to stick to the rules: time and price. Where are you at in that weekly outline that you spent time on when the market wasn't trading, after Friday's close and before Sunday's opening? Wherever that is for you. If you're a churchgoer, whatever, find some time in the weekend. If you want to have a day of rest and you want to observe the Sabbath, I don't tell you what day to use. You have to have one day of rest, period. Don't let anybody tell you what day it has to be. Just one day. Don't do anything on the market that day. But between Friday's close and Sunday's opening, you have to find time to sit down and meditate on that weekly chart. What is it likely to do? What momentum is presently in play? And what is it gravitating to? And by framing those ideas on that weekly chart and transposing them to the lower time frames, suddenly everything jumps off. And it means so much more, and it's much more clearer to see what it is that you've missed all this time. All right, so the idea of how far price runs can go, I'm going to use that here. Just for a frame of reference, I'm going to go back up to the daily chart. I want to encapsulate that entire down close candle here. We'll use a yellow. I don't really like yellow, but all right. So that's the entirety of the bullish order block, and the expectation is we want to see, does it want to gravitate lower and get into this area down here? Okay, and I'll hold off. I'll reserve doing that. You just have that on your chart as well. I'm gonna drop down into a 15-minute chart again. I know it's ugly, but this range is the entirety of the order block, and the expectation is we want to see it trade down to consequent encroachment and go below it. We want to see that weakness, that heaviness, because we want to see the move protract further lower, which would give momentum to being a long holder to stock index futures and foreign currency. This move right here, this move right there, that is your trigger swing. That's the measuring point for what you want to see for protractions or Fibonacci extensions. You take your fib, you anchor it, draw it down to the low of that price swing. Okay, I'm going to show you where my settings are. Again, I've done this in the past. I don't need them. And we'll put standard deviation 3 and 2.5. So here's where we're at. Close it. So we have a high to low, and the entirety of that daily order block is shaded in yellow. Notice that Fibonacci extension negative 2.5, which is 2.5 times the range of the low to the high here. This is all I use a Fibonacci for, folks. That's it. Okay, I'm not in there looking for bat patterns and crab patterns and butterflies and all that stuff. I'm looking at math. Okay, that's it. This is the range that matters, and there has to be a confluence of time being London close, London close begins at 10 o'clock in the morning, New York local time, and ends at noon. There is a buffer I add to it. When there's a big runoff day, it can extend into 1 o'clock. It's far and few between. If you use just the 10 o'clock in the morning to 12 noon, New York local time, as your London close kill zone, it will serve you well. Okay? Huge, huge step forward, Eddie. Watch. At 10 o'clock in the morning to noon, I hope you're having fun with this. I'm loving this. Should have charged admission. London close. Okay, so there's your London close kill zone. This thing's in my way. Kind of pisses me off now, actually. So now here's what I want you to look at. All right. These mysterious markets. Okay, we want to know where price can begin a move and where it can gravitate to. Where is it drawing to? It's drawing liquidity. And we want to frame it in the form of a low-hanging fruit terminus. The inception of a move can be timed. The inception of the move can be determined within a specific price level or within a range like an inefficiency. And in that range, there's 3 specific price levels. 3. That 3 levels is used on a basis of whether we're bullish or bearish. So as I was mentioning earlier, we were expecting this shaded area up here on the weekly chart, that old inversion fair value gap, to be treated as resistance. The algorithm would trade up into it during time. Notice that it reacted here. This is the essentially the midpoint or consequent approach of the entire range. But look at the time of the day. It's 1 o'clock in the morning. That's European open, yes. But the heart of the move, and what I teach by rules, is the high and the low of the day is formed between 2 o'clock and 5 o'clock in the morning. When we get here at 2:45, we're doing 2 things. Number one, we're bumping the high. So anyone that went short up here on dollar-based ideas and long foreign currency, I'm tempted to put the euro up here real quick, but I don't want to mess up the chart before I finish what I'm describing. But we'll come back to this here, okay, in a second. But during the London open kill zone, then it creates the high. You have a 70% probability of the high forming when you're bearish, when you're expecting the market to deliver, as I outlined on the 13th of June, 2023, going to a level I've outlined on the 13th. This level right here is your low-hanging fruit objective. That's not the end of the road. It means that you frame that idea of taking a trade with this as your draw on liquidity. But every single trade I enter, I always look for some kind of a best case scenario, something more than I expected. Okay. Many times I don't ever get that. Sometimes I'll get stopped out. Sometimes it just simply doesn't give it to me, and I change my opinion or mind about where I'm at, and I collapse the trade, or I take too many partials off to justify holding on. And it's an evolving thing, and that's one of the weaknesses I've been very candid about. My exits are always a work in progress, and I've been doing this for 3 decades, so I'm not satisfied. My entries, if I never develop another entry strategy, I'll be fine. I got 81 of them, but you only need one. You only need one of them. So if you were to look at a breaker here, you have a high, low, higher high. Extend the breaker over, you'd be entering short there. If you're using optimal trade entry, okay, I had to fib up earlier. Let me do it again. If you're just using the flagship, the old flagship pattern of my YouTube channel. And this one's going to come off. All right, so these 2 blue lines here, that is the classic ICT optimal trade entry, which is a standard 3/4 pullback. That high to low, it trades up into I'm quite certain that's probably 70.5, which is the sweet spot that I teach on optimal trade entry. If you want to watch anything about optimal trade entry, if it's piquing your interest, I have many videos in this YouTube channel. Just do a search on my channel for OTE, optimal trade entry. That trade up into that right there is perfect. And it's just a beautiful run from there down. So you could use that as your entry pattern. Okay, entering on the fair value gap here, which is the 2022 model. So right away, there's 3 ways of getting in it. There's 3 different models to get in that same price move. Which one do you like? It's a matter of preference. But we have this run here to here, and we have a standard deviation of negative 2.5, which is just outside the scope of the entirety of that daily bullish order block, which is that shaded area in yellow. And you take it back up so that way you know what I'm referring to. This down close candle here on the daily chart, right there, I mentioned on the 13th, that full entire range. As soon as we start moving past midpoint, which is mean threshold, and order block's midpoint is mean threshold. Any inefficiency or gaps midpoint is consequent encroachment. The mean threshold here, if we trade through that when we're looking for lower prices and such, that really bodes well for leaving something on like a partial. But it's Friday, so I've already told you I don't want to hold anything over Friday into the weekend starting up on Sunday because of the gap risk that is available now because of everything that's been going on in the world. So anything can happen, and cause a major sentiment shift where we start trading from where we ended trading on Friday. So that gap risk is not something I'm comfortable with. And you may not have that concern. You may be trading with such an insignificant amount of money and don't want to incur a great deal of risk. And you are willing to take those larger risks based on points or pips, but they won't be so impactful because of the money management you're using. But if I'm taking a trade, I'm not taking a trade with a micro lot. You know what I mean? I'm trying to take something that has real risk behind it, and it will be much more impactful if I'm wrong and I absorb a gap that is adverse to my position that I held over the weekend. So that's why I'm saying it's better to be a day trader right now than there ever has been. So we have a confluence of a negative 2.5 level on the fib based on this price swing. And again, why am I using this price swing here? Because this is a trigger. It's occurring up to a level where we want to see it being respected as resistance, which is the low end of that old weekly gap. It's during the time of day, New York Open, where continuations would form, because the logic is we've already formed a high today. We're trusting, okay? How do you know, ICT? How do you know it's not going to keep going? That's what you use a stop loss for. Remember, I said it's a 70% likelihood if you have the narrative on side. That means you pick the right direction on the weekly chart. Sometimes I get it wrong. I get stopped out, folks. I mean, I've shared where I've gotten stopped out. You've seen where my winning trades stop me out and I don't get the full run. Like, I don't know why you're acting like I don't show it. I show it. And most of you are ignoring the fact that I'm telling you what's going to happen beforehand, and you're not using it to study it real time. When I'm pointing to it in advance, are you going through your charts and looking at it like this? Are you marking up your charts like this? This is a perfect example of what I'm showing. You should be doing these things. This is what you do. When I say back test, I'm not talking about go back in there and using a Forex tester and testing what it feels like to be in there. I'm not saying that that's not useful, but that's a mock up forward walk test. I'm not suggesting that. I'm saying you go back and look at old moves and you annotate your chart like this. And you save these. And in these little areas over here, you talk about and you annotate how the high was formed here at this time and the continuation in the high in the New York session formed here. And it delivered to a confluence of standard deviation negative 2.5 and breached the low of the order block. This level right here is the daily order block. First threshold, where that's where you start the trade as a not start a trade, but you think of it as your low-hanging fruit objective. You don't need it to do all this. You just needed to get here, right there. And that's not even your first partial. Your first partial would be something like below here, or at the the consequent encroachment of this wick. right there. So midpoint of that wick, that low or that low, which one do you choose as your first partial? Neither one of them are incorrect. But you're framing what this is where you think that the low-hanging fruit objective is. So that's your initial draw. And then you watch and see once it gets there, you leave a partial on. How much? Whatever you're willing to hold on to. You have to allow, and I'm allowing for you as your teacher and mentor, I'm allowing for you to bring in your personality to this. You're bringing your own personal touch to this. That means you decide how much you're going to take off at your first partial. In the beginning, when you're first learning, take the most off because you're going to see many times you're doing it incorrectly while you're learning, and that's fine. But you can be happy about being profitable, quote unquote, with your results and still be incorrect about what you thought was going to happen. Meaning that if you thought this was going to happen, as I was co-signing on the 13th of June, I said I think it was going to go down here. If it would have failed to go below there, and I was talking to you today, I would be saying, well, if it would have done that, gone below this low or that low here, you would have taken partials, and it wouldn't have mattered if it went down here. So that's how your analysis needs to make room for you to be wrong, but not unprofitable. You're always looking for a way to take something out, but that has to be predetermined. So if you are anticipating the move from up here and going down to this level here, in that range from here to here, looking left, where is the pools of liquidity or inefficiencies? You can't use this one because we're acting on that as a turn. Meaning, this is what I'm talking about by that. All of this movement here is just this buy side imbalance, sell side inefficiency now has been what? Its sell side's been offered to it now. Look at the bodies of these candles. Look at that candle stopping right there after this buy side has been repriced with sell side. So the down close candle now has provided a repricing to this inefficiency. That starts the framework of this Judas swing for the New York Open. This little run from here to here is power 3. Power 3 is not limited to the daily candlestick. Power 3 can be utilized in any time frame. But this market protraction, this false move up to a level which is the low of that old weekly fair value gap, which is what I told you to watch for that. Does this give you the signature that it's likely to go lower? You had confirmation in London. I teach you in this YouTube channel, in my lectures, that if you're bearish, if you see the London high form when you're bearish and it's breaking down and you retrace in New York, chances are you're retracing to have a continuation lower. And here you have it. So you can't use this as a target from up here. You want to see it go at minimum below that low here. And would you be incorrect by taking the largest portion off of your first partial if you're brand new doing that? No, you're not wrong by doing that. You're not getting a lot of movement, but you're not trading the dollar either. You're trading euro dollar, pound dollar, Aussie dollar, New Zealand dollar, something to that effect. But we're looking for how prices want to go down to this level minimum. So you want to take a partial here. You might want to take a partial below that low here. And the wick. Whenever there's a wick, okay, if your position affords it, always, 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 every single trade, I don't care who told you it's going to go where, and if it includes me, if the price trades to a consequent encroachment of a wick, you must take partials if you're short just above it, because that means it might trade right to that midpoint of that, stop on a dime and retrace and spend some time consolidating, or all right, just reverse. So consequent encroachment of wicks and tails are imperative partial places to take partials at. So if you're short, you have to factor in that price level and the spread. So you want to see the midpoint of that and a little bit above it. If it trades down to that level here, you want to take that as a partial. Always, 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 always cast in stone. It's never going to be a deviation from that rule. If you are trading inside of a range, meaning this high to that target down here, which is that old daily order block, that line is where you think that the low-hanging fruit objective is. You're not saying that it can't go lower. You're saying that that's where you're expecting it to draw to on the downside. It is trying to get there in your opinion. Between that level and this high, you're looking through all of this for inefficiencies. And I already disqualified this one. You have this gap here. Okay, that's a real liquidity void. If you extend it forward, you can use that as an objective, as a partial. Below this low here. But these wicks, these tails, okay, when you have two of them back to back like that, you're taking the longest one. Take the longest one, divide it in half, which you're measuring is the close to the low, half of that, plus a little bit for spread. When it gets there, you'll take a partial. We just happen to have a low here. If that low wasn't here and it was just a wick, it would be even further reason for you to want to take a partial there. I have learned many times when I held on to trades that didn't go to my objectives, these tails or wicks were always the culprit that I didn't notice in my first few years of trading. And it's the consequent encroaching the midpoint of that, where the algorithm comes back down to it and doesn't need to go back down here. It just goes enough into that wick to upset any liquidity. And then ultimately it would reverse if I'm wrong. So that's the reason why I'm teaching you that whenever you have a wick or a tail inside of the range that you're trading in and you're expecting that range to be broken out, you're anticipating that breakout, but you can't ignore any of these wicks because many times they can completely reverse you and run your stop out if you've trailed it, or completely reverse on your initial stop loss. So entry at New York Open at a time between 7 o'clock and 9 o'clock at a level, at a price that's been determined and told to you on the 13th of June. What level? The low of the inefficiency and the middle or consequent encroachment of the inefficiency. Time, London Open, New York Open. Price, consequent encroachment of the gap, low of the gap. All other factors being there, the market starts, breaks. Once this low is broken, we don't know if it's going to go down here. We don't even know if it's going to go here. We're trusting that it's going to go there, which is why you have a stop loss. If we knew with absolute assertion that we're going to see it and it's not going to fail, we would never need to use a stop loss. So you have to trade with managing risk, and the stop loss is essential for you to be able to do that. So we measure how we trade once we take that low out. Does it do it energetically? I would say that's the energetic. The next candle, we open here. That's opening, open here. The market trades up into the range of this high and this low, essentially about half of it. When we see that, the next candle, we want to see it break lower and treat this as an order block. We open, rally up, trade down, we trade through it. It does not need to close below it. Mean threshold is important when we're trading down to an order block for targeting purposes and or continuation. If it closes below mean threshold, that's an indication that it's likely, not a promise, it's an indication that it's likely to continue moving lower. But if we're seeing a brand new up close candle in a sell program, this target here is our objective. Remember, that's the daily bullish order block. The full range of that order block is shaded in yellow. So consequent encroachment, the mean threshold of that order block, I'm just going to eyeball it here. Is 102.565. So we went through that easily and then traded outside of the range of that order block. So now, since we've done this level here, mean threshold, now becomes critical. And we would rather see it not trade up into, oops, we don't want to see this range like this. Didn't do that right. Let's do it like this. We don't want to see this portion of the the range be revisited. If I can get it right where I want it at. And that was the high end of that right here. This was the high order block. This is the low. This is the mean threshold. This section of price action, if it's going to continue, it's best for it not to trade back up into this area here. And because of that, I would treat this as an area of a fair value gap that I want to see stay open. So say this was like the euro dollar, or it was the ES, or an NQ, or something I'm trading. I don't trade the dollar index. I use it as a barometer. Everything I'm showing you here should be a mirror image on euro, and it should be a mirror image on pound dollar. But because of this idea of the order block, and now because we went below the mean threshold of it, I don't want to see the upper portion of that order block now retraded to. It can. It's its best if it doesn't. Now, because I've encapsulated that relative to the mean threshold or midpoint up to the highest point of that daily order block, this section of price action, when I'm looking at price, now you can see right away, while I'm trading on a 1 minute and 5 minute chart, imagine me trying to do all of this annotation and justify why I'm doing it and still watching price, managing the position. It's impossible. But these are all the things that it's in my mind that I'm referring to and weighing out when I'm moving a stop, when I'm not moving a stop, when I'm taking a partial, when I say I want to see a certain range stay open, like this would be a gap. You will all would see that and clearly see that as a fair value gap right there. This low and this high, that one candle here, that's a SIBI. I wouldn't want to see it trade up any. Now it can trade up to the midpoint, which is mean threshold, go just above this candle's high, and then resume going lower. That would be institutional order flow entry drill. Trusting that this is not needed to be traded to or up into this area here, as I had indicated. Oops. From this high down to the midpoint. So again, you don't know order blocks, so stop trying to teach them. But the point is we trade down, okay? We trade down into targets until we get to time. The high of the day formed in London Open, exactly how I teach it, 70% of the time. If you're bearish, the high is going to form between 2 o'clock and 5 o'clock in the morning, New York local time. If that is true, New York session will have a high probability of continuation of the same direction that London already establishes. That means the highs formed in London. We have a price area that we want to see respected. We've already worked the midpoint of that old gap. The low is now the sensitive price point. That's the level of price. But it has to be traded to at the time of day that the algorithm will refer to for new delivery. New delivery is a lower low in the day. This protraction higher up into New York Open, and the time and price is meeting right here. Then we have this acceleration to the downside. Until we get to when London close starts at 10 a.m. Now at 10 a.m., you're watching. Does price hit your target or multiple targets? If it does, now you're in a position where you could potentially see a market reversal profile. London close generally makes the extreme end of the day. So if we see the high of the day form in London, the low of the day forms generally in this little time window here between 10 o'clock and noon. Don't take my word for it. Go back and look at your data. Look at your old moves. Your charts every single day, with the exception of this right here. Get that off there. You should have the minimum of just that. Just that. That in itself, and all the annotation areas over here that you could fill in with all your observations, and you cheerlead yourself. And you say, it was amazing to see how the level I expected on the 13th of June to be respected as resistance, which is that old weekly inversion fair value gap being respected here. And then it started its framework in the London Open, creating the high of the day. And it traded all the way down to, just like I teach on YouTube. Listen, this is all in videos. All in videos. Years and years and years and years of it. And the rules have never changed. It's always the same stuff. The algorithm is not changing. It's not. It's not. It hasn't. It won't. Period. What will happen that causes it to stop working? We are not trading anymore. We won't be permitted to trade anymore. There you go. That's how it ends. So you got a bigger problem than worrying about whether it's going to work or stop working if that happens. So as long as there's markets being offered to trade, this logic is always going to be used. Period. End of story. Rest. All right, so now I'm going to take all this information here, and I want you to keep that in mind, and we're going to go back up into a daily chart, and we're going to segue over to, isn't that beautiful? Look at that, how it looks on a daily chart now. Completely random. Euro dollar. We'll take our next break at 11:30. It'll just be a 5-minute break, in case you're wondering. I got a PICT. When can I take a break? So here is euro dollar, and you remember I was talking to you about how on the 13th I said that there's a small little gap in here, and then we have this order block right there. Okay, so I encapsulate that entire range of the order block in that area right here. Yesterday we traded up into it there, and then today we had this gargantuan move outside of it, which is supported by the weakness that we've seen in the dollar index. So I'm not going to spend a great deal of time going through this one because everything I just showed you in dollar will be a mirror image, or should be a mirror image, of everything you see here in euro. So we're just going to drop down into an hourly chart because there's a lot of things I want to cover, and if I'm not careful, we could be into this thing till 8 o'clock tonight. And while I make allowances for that because of energy, I could do it, my wife probably won't permit that. So I want to stay married, folks. Okay. All right. Yeah, here's your hourly chart. And we were looking for a price wanting to eventually gravitate from the 13th. We want to see it gravitate up into that gap. Let me scroll it over here. So it's this high and that low. Okay. One of the things that I would counsel you to do if you're going to be doing a lot of annotations and journaling, which is what I'm trying to cultivate in you as a student, whenever you anchor your annotations and lines on from the higher time frame charts, when you drop down to the lower time frame, like I'm showing you here, the highs, you want to make sure they toggle on to the very specific levels. So that way it makes your charts neater. I'm saying that because I'm obsessively compulsive. It probably may not be a big deal to you, but if you don't have that in the beginning stages, it would be easy for you to gloss over key levels and where they were referencing from respective times of the day. And if you're going to learn, you're going to do it right. Otherwise, you're just wasting an opportunity. So we have on the 13th, which is here, market drops down, takes out sell side. What is this high right here? Last up close candle, what is that? It's not a breaker. What is the purpose or function of a breaker? Mitigation. So a breaker, if it was a bullish breaker, we would see a low, a high, and a lower low than that low here. But we're not seeing that. We see a low, high, a higher low. So it didn't go lower here. So that makes this high here a mitigation block. Similar in scope, but the definition of what makes it a mitigation block is that distinctive feature. So if you take that range here, extend it out in time, perfect. What's the low of this candle here? Look right here, okay, upper left-hand corner. What is the low of that candle? 1.07746. That's the low of this candle here. What's the low of this candle right there? 1.07741. So it respects it, colors outside the line just a little bit, rallies. But look at the bodies. What did I tell you about the wicks versus the bodies? The wicks do the damage. That means you have to allow for these little mohawks. Okay, I got a lot of questions about. Folks saw that video where I was trading the index futures. and I annotated where it was trading down outside of the fair value gap. And anytime it does that, my mindset is it's allowing for spread. So I don't lose my mind if it just makes a little small little wick outside of a level, or if it's outside of a fair value gap. If it's like one tick or two ticks and it immediately comes back inside the range, I'm comfortable with that. You might be freaking out if you're trying to trade before you're supposed to be, and you're ill prepared to do it. You'll get scared out of the trade or not trust the level. Where if you watch when I'm doing executions, I'm allowing for these things, and many times I'm annotating it right then, real time, saying, this is a mohawk. If you ever see a mohawk or hear me talk about a mohawk, it's just when the price action has a little tiny little movement with a wick that's just outside the lines that I would see as if it was everything perfect, like no deviations from the actual high or low or the range that's defining an imbalance. It can color outside the lines, and it's completely permissible. It does not upset my expectation. It doesn't unsettle me. And you get used to seeing that when you do these annotations. You trust yourself and your observation and reading price when you see these things repeating over and over and over again. So anyway, that's a mitigation block. And the market accelerates during the the London open kill zone on the 14th at 2 a.m. So we had sell side in here. We drop down into it. That's your Judas swing. The market then rallies quickly up into the levels I told you on the 13th it would do, all the way up to the high here today and through it, just like we saw happen on the dollar index. So if you are a euro dollar trader, okay, you want to have a reference between that and we're looking at the dollar index with it. So you want to constantly be referring to what you're seeing on the market that you're trading versus the dollar index. So everything you're looking at in price for your market of study or trading, you're constantly getting feedback in relationship to the dollar index. So if you're looking for the dollar index to go lower and you feel like you just can't hold on to a trade that's running for you and you have a partial on and you just, if you're traded with real money, you know exactly what I'm talking about. It's stressful to be in a winning trade like that where you just don't know when to close it. You don't want to close it too soon because if it runs, it's just going to keep reminding you that you just got out on emotion. You should have just held on to it or put a stop loss at a point where you can be comfortable with it. You move up half of the open profit and just leave it there. If it stops you out, who cares? Because you've taken a larger portion off already in partials. But the way you beat that uncertainty or that nagging feeling of, I don't know when to get out, you're constantly referring to the dollar index in relationship to your market of choice. So if you're trading euro dollar and it trades to the high end of the order block here and it trades to the low of the order block over here, you're already looking for signatures to support it, complete runoff and keep on going lower. But when we get time of day like we have here, as soon as we enter in London close, you have to have the majority of your trade off. You have to. Number one, it's Friday. Two, London close is generally the time when it makes the opposite end of the daily range. So we have the London high forming here, the high of the day. We had all this sell side delivery and over delivering in terms of what we were expecting, which is wonderful. But when we entered a time of 10 o'clock to noon, New York local time, generally a lot of the volume for for Forex and currency trading starts to dry up between 10 and noon. And later in the afternoon, yes, you might see these little fluctuations, but I'm not a fan of afternoon trading in currencies. Like I'm not a fan of it. The bulk of the volume is going to be encapsulated between 2 o'clock in the morning and noon local time in New York. So the way I just ignore any potential blow off moves is I have rules and I have to have closed up shop sometime between 10 o'clock in the morning and noon New York local time, especially if we've had targets hit and these multiple targets have been hit. If you need to leave a very small portion on, then it's okay to do that. But just know that it's probably going to stop you out, and it's okay because you're holding a small portion on. But if it runs, it will satisfy that I need to be in there in case it runs. But you're still going to regret not having the full position on. So you're always going to be wrong in that regard. And that's why I'm telling you my exits. I'm never satisfied with that. I don't have a strategy that satisfies me every single time I take a trade. But I can find profitability in every trade I'm getting into because there's partials always available. And that part is a personal aspect of trading that I teach and make allowance for. You might not understand that allowance as being a factor coming into this, but that's what you're doing when you take my information and concepts and it makes your model. It's uniquely yours. How you engage with price action, what you're comfortable with. You're never going to trade outside these parameters that you defined for yourself. How do you start there? What parameters and what framework do you apply? These right here, which is time and price theory. This is not form fitted today. This is exactly how I teach it. My students have seen these things for years. You're going to see these things for the rest of your life. If you study price action and you trade, you'll see these things repeat every week. It happens every single week, which is why my slogan is every week, every day, and it won't stop, because this is the marketplace. All right, so let's go into a 5-minute chart. And take a look at how we traded up into. On the 15th, we had sell side here. Then we dropped down. Classic signature of London Open is a stop run. London Open classically seeks sell side or buy side liquidity. You don't have to have the confidence to go in and buy the sell stops. I can. My students have learned how to do that, but it's a very, very hard thing to learn because you have to see years of this type of stuff to desensitize you. It's easier for you to wait for this run here and then judge, does it have displacement higher? Swing high. After it takes stops, fair value gap, it drops down into it here, rally. We want to see energetic run once it clears this high. Does it do it? Yes. In itself, at this time of day, is 3:55. What time of day is that? London Open Kill Zone. Between 2 o'clock in the morning and 5 o'clock in the morning. This fair value gap right here is the silver bullet for Euro for today. You only need this low right here to trade to. There. What time is that? 4:20. Sorry, just a joke. Some of you probably won't get that. No, I don't smoke weed. But there's your silver bullet for London Open. And it rallies up to what? The low of that fair value gap I told you on the 13th of June. That is what? What is that? That is your low-hanging fruit objective. You don't need it to go all the way up to mean threshold, which is half of that shaded area in purple, which is the order block on the daily chart. You don't need it to go there. It can, but you are framing on the basis of getting into that fair value gap. Now, why am I not using the low of the order block? Because that gap is there. The inefficiency takes precedence over the order block. Yes, the inefficiency takes precedence over the order block. This is where you would see it reach for minimum. Does it react there? Sure it does. Trades back down into what? What's it trading into? A low, high, lower low. What does that make this? A bullish breaker. Extended in time. What time of day is that? New York Open Kill Zone. 7 o'clock in the morning to 9 o'clock in the morning. There's your little sweet spot. What does it do? Rallies. How high can it go? Well, we have to determine a fulcrum point. Fulcrum point is here. Why is that important? If it runs through this high, we can start doing measurements in the form of standard deviation. So we can take that low, project it up this high here. Standard deviation, -2, -1.5, 1. This is a measured move. Okay, so from this low to that high, a classic ABCD type thing or measured move, and that's it right here. You want to absolutely have the lion's portion of your trade off there, because what else is that in close proximity to? The high of the order block. Remember this shaded area here. This shaded area is, let me drop up into, or not drop up, but go up into this up close candle right here, right there, right above my cursor. That's what I'm highlighting here, the low to the high of that. That's what I'm showing. So back down in, measuring that low to high, and this is the fulcrum point, meaning that when price trades to it and through it, it has to go through it before you can get any of these measurements. That's the measured move. Lion's portion of the trade should be taken off there because it's in close proximity to the high of that order block. It could very easily stop there and consolidate into the rest of the day and then continue on Sunday into Monday. But allowing for continuation, when it gets to the high of the order block, you need to consider taking partial there. -1.5 and 2. That's 2 times this move here. Whenever you get that type of move, that's very, very extended. So 2 standard deviations. I teach in mentorship that 2 standard deviations of like the Asian range or flout or central bank dealers range, central bank digital currency, hear that? Central bank dealers range, those ranges that I use for measuring protraction and how far a high or low can move before it makes it. That same principle applies here with all price swings. -2 standard deviation is one of those levels where there's a lot of reason for you to be wanting to be either out of the trade or have such a small little piece on. If you're going to leave a runner on, it's about, at that time, we usually peter out, especially if we do so when time is met, and that being 10 o'clock in the morning, New York local time, to noon. That's London close. So for your notes, especially with the folks that are brand new, when markets are going down, or we're expecting the daily candle to be a down close candle, between 2 o'clock and 5 o'clock in the morning, generally you're going to see the high form. And generally, the New York session between 7 o'clock in the morning and 9 o'clock in the morning, New York local time, will create a continuation pattern. Now, sometimes there's a reversal of that, where London creates a high, sells off, and then New York runs out the London high, but then reverses and makes the lower close in the day. Those are always on the heels of a high or medium impact news driver. That's the only time that occurs. So how do you know when the low is not going to be taken out or the high is going to be taken out in London and you can trust the New York session? I just told you. Man, I should have charged money for this one. So we can see there's a lot of consolidation in here. We had a high. It ride above it. If I was long on euro, this is running down equity. This is the principle. You see me do it all the time in trades. If I'm long, and admittedly, I was sleeping last night preparing for all this, so I didn't trade euro, and I've been trading Forex for a while now. As soon as it trades above this high, you want to be taking partial and exiting your position. It's offset distribution, and the principle is running down equity. That means you're selling to buy stops. You're selling at new highs. You're buying low and selling high. Where do you define high? Every time it takes out a swing high. When you're long, if it's long in the tooth or it's been going for a long time, like we did here since 8 o'clock this morning, it's good money practice for you to be selling every time it makes a new high if you have position available to do so. In my personal opinion, if you look at what we're seeing here, do you see how the euro has made higher high and the dollar didn't make that lower low at the same time? Market symmetry suggests that in a perfect world, the US dollar should have made a lower low there in concert with the higher high in euro. This is a USDX SMT divergence. That means dollar, which is USDX, and euro are not in agreement with what they've done at a time of day that is critical, London close. So this would make me very, very cautious to expect higher prices, and I'd be real content with closing all of my position in longs on euro dollar and going into the weekend happy that I've destroyed it. So anyway, that's the business there. For your study, you want to go into the June 13th live stream on my YouTube channel, June 13th, 2023, for the folks that are watching this in the future. And go to the 7-minute and 20-second time on that video, and you'll hear me outline these two levels here and this entire range here, and that would be the draw on liquidity that was mentioned on the 13th. That means we were over here. We got here. Yeah, we're somewhere in here. I don't know what time of day we were talking, but we were using this idea that we would expand up into that on the 13th, and today we're up here and through it. Okay. So when I'm looking for SMT divergence is, I've never really settled on the real name for it. It's a smart money technique or smart money tool. I use it interchangeably. It's just a matter of looking at the relationship between closely correlated assets or inversely correlated assets, meaning that euro dollar usually goes higher when dollar goes lower. But if you look at times when they don't agree, so if dollar makes a lower low, a symmetrical market is a euro dollar going higher high. A euro dollar making a lower low and a dollar index making a lower high, that is not symmetrical. They have to agree. So euro, higher high, lower low in dollar. Euro, lower low, higher high in dollar. If ever at any time that it's doing that during key times of the day, which key times is the day for Forex and currency pairs? London Open, New York Open, London Close. Yes, you can trade Asia. Yes, there's opportunities in Asia, but the scope of this workshop today, I don't want to focus on the lowest volatility. I want to take you to where the meat of these daily range moves, and for the weekly opportunities that are available, I'm telling you how to go in and see where these algorithmic price swings are going to occur. Okay, so every institutional price swing that forms in price action in Forex and in the dollar are going to be primarily inside the time windows I'm telling you. Now, by itself, when I first started teaching this, skeptics and skeptics alike would come out and say, this is nonsense, all hindsight. But it was for you to learn how to trust where these things will occur. And by pattern of recognition, seeing it repeat over and over again, you learn to trust that these are the times when things really happen. Now, the problem is, everything that I've done so far in this live stream today, that's all foundational for you to determine how price is going to react and how it trades to where. But you can quickly see how many of the opportunities that you think are a surprise sometimes, after they happen, because you're really not that versed in trading. The idea of knowing how they form and why they form, what they're reaching for, helps remove all that uncertainty. Now here's an interesting thing here. You can see how I told you that I would be done. I would not hold on anything longer for euro dollar. It's 11.24. I would have already closed the trade on this. If the euro dollar goes higher and the dollar makes a lower low, I would miss whatever that move is on the upside on euro. I would admittedly, because I'm obsessively compulsive, I would go back into there and try to justify. I'm not suggesting that you do this, but I want you to know that as your mentor, this is a struggling point for me. So I had to have rules that stated that once I come to the conclusion that time is now at a period of time in a day where the opposite end of the range is formed, where we've been seeing it go lower, that means that the low is probably forming sometime between 10 o'clock and noon, New York local time, for dollar. that means that the high is forming sometime between 10 o'clock and noon on Eurodollar. There can be, like I mentioned earlier, in Forex and in currency pairs, there can be a bleed over into the afternoon in the New York session. I am not worrying about the dollar or futures contracts or even the Forex currencies during that time of day. My focus would transition from Forex to stock index futures. So that would be my trading day would move from Forex overnight and then go into bond trading in the morning session. And then I would either do an overlap with index futures or finish my day in Forex. And then at London close, all my focus goes to New York lunch hour, trading the run on stops that was taking place on the holders of longs or shorts in stock index futures. And then I would prepare for the afternoon session. And then I would do some kind of a bond trade in the last 30 minutes or whatever on market on close. And that would be my trading day. That was how I did things. And when I stopped trading Forex and went back to my roots of which is index futures trading, because that's where my focus is, I'm teaching price action with that medium. But you can clearly see all the things I'm teaching you here that are already in my YouTube videos. I'm taking my opinion of how I would teach the folks one-on-one. This is exactly what we'll be doing every day, all week long. We going through every single thing that I told the person the previous week what would happen, and it would give them a foundation. And then come the middle of the week, I would say, okay, based on what we're showing you, where would you focus on your trading? Where do you feel compelled to trade? Do you want to trade on an hourly time frame and try to get like short-term intraday trades, or do you want to scalp where you're using a 15-minute or less? Or do you want to be a short-term trader using primarily just the daily chart and using the open, high, low, and close for power 3 to get your setups to trade for 1 to 3 days of short-term trading? And depending upon what the student would tell me, then I would spend the latter portions of the week framing that out in a model for them so they can go home and start working with that. That's what I did in the mid 90s. So I want to kind of get through the other markets and then teach you how to trade the FOMC, non-farm payroll, and CPI stuff. So let's go back up to a daily and go over to the pound, and then as soon as I load the chart up and get it set up, we'll take a 5-minute break. So you want to be a trader. All right, folks. One more time, if you could just give me a 5x5 on Twitter. Let me know before I start talking again that you can hear me fine. Can you hear me? I'm not sure you can hear me or not. I'm checking Twitter, by the way. Thank you, Mo. Professor Chummy, thank you. Appreciate it. All right, so we're looking at the cable market. So on the 13th of June, 2023, the live stream, for your notes, if you go to the 14-minute and 25-second through the 16-minute and 10-second, you'll hear me talk about what I'm going to refer to here. So it's not cherry picked, it's not hindsight, it's foresight being shown to you in your face. Okay, so I mentioned that pound would likely move higher. Now, why would pound move higher? Because we are expecting the dollar index to go lower. So we measure, again, the same way we were doing with the euro dollar moments ago. You're constantly looking at the relationship between the dollar index and the market you're trading. So if it's in Forex that you're trading, you're constantly referring back. You don't just simply look at the market you're looking at as a trade and that's it. I don't know if this splitting the screen into two requires a specific membership or whatever. I don't know. I can't recall. I know I have the highest one that is available, but it is what it is. I mean, you're going to have some kind of way of having two charts up. And while you don't need 12 monitors like I do, I don't need it, I'm saying, but I have 12 monitors available to me. I'm constantly referring to all the markets I'm looking at to keep a good measure of. I don't have them open now. I'm in my trading office, but I'm literally just talking to you on a laptop, the one I used when I'm making my presentations all the time. So I'm only limited to see what I'm showing you here. But at a minimum, you have to look at, if you're trading Forex, you want to have the dollar index and whatever market you're trading. You have to cycle through the time frames. Okay. So on the 13th of June, 2023, I did a live stream and talked about how the British pound would need to go into this fair value gap, go above it, and treat it as support before we would see a meaningful move up. And I said I wanted to see it trade up into this shaded area here, which I'll take you over to. That's the weekly gap. Okay, it's a fair value gap right there. So this inefficiency right here that has that big down close candle, it's defined by the candle to the right. That candle's high. And this candle's low. So the candle that's right there, that's what I'm encapsulating in the analysis. And that was in the June 13th, 2023 live stream. I said that we would expect it to trade up into that because it has unfinished business up here. They were the terms I used. If we drop into a 60-minute chart, okay, you can see on the 13th is here. We were talking and doing our business on the 13th all through here. And I said I want to see how we try to trade up into that gap that doesn't appear on this chart. Now let me go back into the weekly. Visibility on all intervals. So now when I drop into the 60-minute chart, it should appear. There we go. But this gap here is on the daily chart. As I mentioned, I wanted to see it act as support. We have a down close candle here, which is an order block, which is at the near top end of that range. We expand outside of it. We come back down into the order block, which is a down close candle right there. And then look what we're doing. We're working this level here, here, and then that time right there on that candle. What time is that? I mean, that candle right there touching the top end of that daily fair value gap that I told you on the 13th between 14-minute and 25-second and the 16-minute and 10-second, that minute marker for the June 13th, 2023 live stream for pound dollar. I stated that I want to see it trade using that fair value gap as support, permitting it to trade as much as consequent encroachment, which is the midpoint. Okay. Because we have this down close candle and because we have the breaker, low, high, lower low, extended in future, order, not order block, bullish breaker. We have an order block here, trades down into it, and it's also working and respecting that old daily fair value gap, which we're treating as a inversion fair value gap. Remember, on a daily chart, it looked like this. It's this inefficiency on the downside here. And if you think you understand what I'm teaching because you watch one or two videos and you think, oh, this is one of those optimal trade entries, it's got a fair value gap, let's go short there. That's not what you heard me say on the 13th of June. I said we want to see it trade outside of it, come back down, and you can see it happening here on the daily candlestick right there. So before I drop down again, think about Power 3. Power 3 is my accumulation, manipulation, and distribution theory. And it was the major transition from relying on everything that I had learned from Larry Williams and capitalizing on something that he admitted, much like I admit my weaknesses are my exits. I'm never satisfied, no matter how good they are at the time. Afterwards, I'm never satisfied with it. So I'm highly critical of myself in that regard when I shouldn't be. And that's why I try to teach you all, try not to do those things, because it's plagued me my entire career. I don't find any satisfaction in any of it. But it's not about being perfect, and I'm pursuing perfection, and I already know I'm not going to obtain it. But one of the things I heard Larry talk about in 1995, he said that his struggling point was understanding how to be a buyer below the opening price, because most of what I was learning from him at the time and what he was teaching, I haven't kept up with him. I don't know what he's doing now and what he's done and evolved from what I was learning from in the 90s. But at the time, I bought everything he had, everything. So either it was given to me by friends in the industry, sorry, Larry, but or I paid for it outright. And at the time, I loved everything, and I wanted to use everything that he was teaching, and that was a problem. And that's what many of you do with my concepts. Don't do that. Find your model, look for what it is you're trying to trade, what type of trade you're trying to be. Is it swing trading, short-term trading, day trading, intraday scalping? And then what asset are you going to focus on? Futures, index futures, currencies and Forex, crypto. I don't trade crypto, but I have students that have made lots of money trading crypto, and I can't co-sign for it, but they swear by it working in there. So I have to be very careful because I do nothing with crypto, nothing. And I have no affinity for it. So that's why we won't talk about it. We don't talk about it. But I do think Bitcoin's going to zero. Anyway, the low of this candle right there, after the opening, it trades down. Now, I'm not using this opening price. I'm using levels that I taught in the core content for the day trading. I'll refer you back to that. For the life of me, I wanted to make a note of this in my notes so I could tell you what month it is. But if you follow me on Twitter right now, if you can recall what month it was that I did all the day trading stuff, where I focused on day trading, I taught a lot about opening prices in there. And I just, for the life of me, I can't remember which module month it was, but it's already on my YouTube channel, so I promise you it's there. It's free. You can go look at it. But You can still use the trading view settings. I don't trust them entirely with this setting, but the principle is this. If you're bullish, if we are bullish, if I am bullish, I'm looking for the market to create these up close candles and draw into a level that I've already predetermined. So right away we had buy side here, resting above here. We want to see get up into here because this is an unfinished business. This is all this range up here. This is the 14th, so this would have been the actionable day because we were talking about it live on the 13th. But the day that you would be using the information would be the very next day on the 14th. So we have the open. It trades down from the opening into the high of this gap. That's not supply and demand. That's not. It's not even trading back to this down close candle, which you would see as an order block, right? This was the level I told you to watch, but permissible to the extent that it could trade down to half of, which is essentially about right there, which would be meaning what? It can trade to the opening price of that down close candle, which would be in what? A bullish order block, which is the reason why I said that. Focusing primarily on using the fair value gap as a form of support before we would see any meaningful run higher, this signature has to make itself present. We happen to open here and trade down. That little movement down is what I refer to as a Judas swing. It's a fake move. And all that's occurring on the 14th or Wednesday, yesterday. I know I have the title of this live stream noted as Friday. The reason why I did that is because my notes, right here, I have at the top Friday workshop. So that's why I keep saying Friday every time I look at my notes to keep myself on track. My subconscious is saying it's Friday. I know it's not Friday, but because I wrote it incorrectly this morning, I keep running with that. So the live stream's title will change to a Thursday, obviously, but that's not me editing anything except for the title. All the content and everything's here live. You're all watching it. I don't know how many people are watching, and if I looked, I'd probably be nervous about how many people are doing that. But to stay on track, just know that I mentioned that this occurrence here would be what we would be favoring, and then we would want to trade up into this range. Now, I taught recently, and I don't recall what video it was, and this is where I'm weak as a mentor. I don't do a lot of indexing or table of content stuff because if I start that, I'll want to go nuts with it, and I just don't have the time to do it. And this is more than enough. You're getting this for free, and it's worth more than any other out there that you would buy as a course because it's been proven to you before it happened. I told you what to look for, and I'm telling you now what I used to get to that understanding, and it will repeat. It doesn't change. It doesn't fall away. These are the same things that I've been using for 30 years that work continuously over and over and over again to be able to call these moves in the marketplace, which is the only thing I promise. I can promise you that you will read price action very, very precisely. Whether you find profitability with it or not, that's the hard question because you will bring in your own character flaws. Just like I have a character flaw with my acceptance of whatever I do as an exit on my positions, whether they're profitable or not, I'm not satisfied with that. So I want you to understand that I'm not AI. I'm a human being that frustrates me, and it's plagued me for 30 years. Don't do those things with your development or create those things for your trading because if you do that early on, they will derail you. And I actually learned the majority of what I know in my first 3 years. But I messed up by trying to change things, improve things that were already perfect. And one of the things that I had set in my mind that I would have a perfect exit. And I'm never going to have that. I'm convinced I'm never going to have it, but because I'm wired to be obsessively compulsive, I wrestle with that. So I teach you how to overcome that by not trying to go into it in the early stages of your training. Because if you create character flaws in your trading early on, you wrestle with them for the rest of your life. And there is no magic eraser to get rid of them. You wrestle with them the rest of your life. Every time I look at a market move, if it's something I wasn't watching and it happened, even though I know I didn't need that move, it pisses me off that I didn't have it recorded and executed so I can show it to the community, because I know I would be in that trade. I'm sometimes thinking about a trade that I got hurt in, and because I see something that my subconscious, I've looked at things for 30 years, and if I see something and I got hurt in it in the past, I remember that, and it's a distraction, and I wrestle with that. You don't have that yet. You're brand new. You don't have those war stories and scars that you have to, oh yeah, I remember that happened, but that's not this trade. So that's the reality of this. You're going to pick up a lot of painful scars and wrestle through that the rest of your career. Nobody ever gets to a point of mastery where they don't have any kind of emotional tug of war that takes place. Because if they have real experience, invariably your mind's going to go back to a time when you were in a trade that looks similar to this one. And then you got to push through it and stick to the rules. The rules say stay with the trade. I don't care if it hurt me this many times years and years ago. It looks like the way it does. You see all these guys that make. I'm getting somewhere, by the way, with this. The folks that draw out these charts and says, look at this. The last time in 1929, the chart looked like this, and it's going to crash. And everybody's been calling for the crash, through the summer. And I said, I don't think we're going to crash. I don't think we're going to consolidate. We could consolidate, but I think we're going to go up higher. And we've been going higher. So my rules stated that I should have looked for and expected, as you know, I wanted to see the seasonal influence that I'd like to see that takes us into a low in June and have that little bit of a drop. But that seasonal tendency didn't materialize. And throughout that seasonal tendency, you heard me calling it higher. That was only learned by experience. But I also stated that when a seasonal tendency is likely to occur, a seasonal tendency, by the way, if you're new, is simply a certain time of the year, certain month of the year, certain asset classes or a particular market performs a certain way more times than not. So it's like it's like a seasonal tendency for snow. It's not likely to snow in New York in July, and it's not likely to go to 90 degrees in February in New York. When that stuff happens, we probably need to be paying attention. But generally, seasonal tendencies state that those are the normalcy. Well, there's a factor in the marketplace that we refer to as a seasonal tendency that I was expecting, and I've used many times over the years, that the low forms in June, and there's a decline the last week of April going down into midweek of the second week of June. Now, it doesn't form all the time, but as I indicated in my lessons about seasonal tendency on my YouTube channel, and also as I mentioned recently in the last few months, that if a seasonal tendency does not form or continue like it does in the past, the fact that it's not there many times is a very strong indication. Like, for instance, I'll give you an example. I would have liked rather to see the stock index futures to trade lower throughout May into the first or second week of June. That's what I wanted to see. Now, wanting to see something and then taking that want and then trying to impose your will in the marketplace and try to force a trade into it, that's what I did when I was 20 years old. And that's how I blew my accounts. When I did those things, I was forcing my will and what I wanted to see happen versus sticking to what the market's telling me. Now, as a more refined analyst, when I look at price action now, I defer all the I want versus what is this algorithm telling me? What's price action showing me in the chart? And a lot of people were trying to, look for shorts. The older timer guys were saying the market's going to consolidate. And I said, okay, well, if the older crowd saying we're going to consolidate and the retail saying we're going to crash, I'm going to trust everything that's saying it's going to go higher. So if it's going to go higher, what's it going to reach for? Buy stops and inefficiencies. And that's why I took you to the weekly chart and the daily chart to also answer the folks that don't want to day trade. They want to see longer, higher time frame perspective. They don't like the 1 minute chart stuff, okay, because they think that that's useless to them. But that same thing that I'm using on a 1 minute chart, I'm using on a 15, an hourly, 4-hour, daily, weekly, monthly. It's the same thing. The same idea that I'm using inefficiencies and liquidity in market structure there's a plethora of setups that are happening all day long, and you're never going to run out of setups. But the problem is you're not giving yourself a chance to trust what you're learning is going to give you more than you ever need. Like I could be here all day long, every single day, all night long, finding setups here, there, all over the place. If I pushed like that, I will take losing trades more than you see me showing you. But I've learned where I want to take initiative and say, I want to only work here. I have insight that, allows me to be more accurate in that regard. But I teach you how to find that, and I'm doing it today, how to find the choicest cream of the crop setups for the week and live there. Once you nail down a win like that, stop. Don't trade again. If you're a YouTuber, stop. Let your audience see that you're controlling yourself and you have discipline. It doesn't matter that you come back the next day and you trade and you're live and you say, I think I should be done. If you're asking your audience whether you should stop trading or not, you're not in control. You're being driven by your audience. So that's another thing that you have to ask yourself. Why are you learning how to trade? Are you wanting to be a YouTuber where you're allowing the influence of your viewers while you're trying to act like the influencer? If you act in a manner that you're trying to teach or showcase what you're doing and you're allowing this audience to influence whether you take a trade or not, you're not in control. You're letting outward things create impulsive decisions about you taking on risk. So it's important not to get wrapped up in that. I don't listen to people that say, dance for me, monkey. I'm not doing it. I know what I make mistakes in. And when I get impulsive, my emotions, and I'm bipolar, I can't trade when I'm in a manic episode. I can't trade when I'm in a euphoric episode. So it takes a great deal of focus for me to even have these kinds of discussions with you. Sometimes it's next to impossible. And if you listen to, you know, episodes in the past where, I get either emotional or I go off the rails and get a little bit more belligerent than I should. It's not because I plan to do it. It's because I have a chemical imbalance. So I have very rigid rules that I've had to place on myself, much more rigid than the average person, because I battle a mental illness that is very hard for me to wrestle sometimes. And trying to trade and be in an industry that's highly technical like this, it's not easy. It's really not easy. So anyway, talking about the power three concept is the accumulation, manipulation, and distribution concept of using it on a interval, any time frame. But I introduced it with the daily chart because, like I mentioned in the beginning of all that rant, I warned you they could probably come up. I learned that Larry Williams I never found out if he ever figured it out because he mentioned at the time in 1995 that he had a weakness or an uncertainty as to how to determine when to be a buyer below the opening price before you see these big ranges. And at the time, I was learning under his tutelage of his books and his VHS tapes and courses. That's how I was learning. He was my first real mentor, and I still have a great deal of respect for him. But I did move away from most of what he taught and what I learned from him. But there is a hallmark to a lot of the things that stayed with me because they're just market truisms. Um, a market day that has a big range. He taught that usually the open is near the low or the high of the day. So how do you use that information? If it's expected to be a bullish day, and remember, go back into the 13th live stream. If you haven't watched that live stream, I promise you, don't watch it after this one because we're going a long time today. Tomorrow or over the weekend sometime, watch the 13th of June 2023's live stream. And all those things I'm talking about, you'll be able to see this forming here. But when you're looking at a day, when you're anticipating bullishness, you're expecting not just one day of movement up, which is why I take you into the weekly chart. That weekly chart might have only a one day event that creates the run to what we would expect as a draw on liquidity. A draw on liquidity is where price is likely to reach to, whether it's reaching down for sell stops below an old low or it's reaching down to a fair value gap. That's the only reason my price goes down. That's it. In the reverse, when it's likely to go higher. But we look at the weekly chart with the expectation that there's an expansion move. We don't need to predict the close of the weekly candle. We're just looking for this price movement with magnitude reaching into an objective that we've identified on the weekly chart. So because of that, we're taking that insight and we're transposing it to our lower time frame charts, daily, 4 hour, 1 hour, and anything less, all the way down to 5-second charts. I said that correctly, 5-second charts. So if we're bullish and we've arrived at the dollar going lower, cable or pound dollar, as we see here, is likely to go higher and move up into this shaded area, which is what I referred to as the unfinished business. If it's going to go higher, where's it going to go? Well, you have this high to this low. And what has already happened? We went to this high here. So what's resting above that high? Buy side. So the minimum threshold would be to what? Reach up to where? This is a trick question, by the way. If you're buying here at the top of this fair value gap, as I outlined, that we would be expecting something like that to form when we did our live stream on the 13th of June, we would expect the market to open, trade down. Any down movement into this gap will be treated as a Judas swing or a fake decline. Retail will chase this every day. They get caught up in it. They want to get short on a breakout. They're using some 5-minute, 15-minute breakout rule in London or New York or whatever, and that is a fake move. It's designed to do that very thing. Why would it be interested to do that? Because those sell stops being triggered to get traders short, chasing it, they think it's going lower, is the perfect counterparty to smart money going in and buying it, because they're the sell side to their buy. Every long has to have a sell side. Every short has to have a long side. So the dance between liquidity and how it's utilized in price delivery, you have to take a step back away from thinking about things in terms of overbought, oversold, and indicator settings and things like that, and look at who's available right now to take the other side of my trade and utilize that as like a bus stop, okay, or a mile marker between where you are and where it's ultimately going. Terminus is your low-hanging fruit objective. That is not the end of the move. Terminus is just where you define where the low-hanging fruit objective is. If it just gets that far, you've made money. If it reverses there, great, you've already made money. If it continues, you have something there that could potentially pay more. But you don't need it to. Notice what that would do for you. If you haven't considered what that would impact you in terms of your psychology of the trader, you're not putting so much unrealistic expectation on yourself. You're literally just placing a realistic objective. And what would that be? If you're going long here and it runs up and hits the low end of that imbalance, that's profit partial 1. Now, if it doesn't go to consequent encroachment of that wick, what do you think of that? That's a partial. Why? What I said earlier. Whenever there's a high or a low that you're expecting to be breached, traded to and through, if there is a wick or a tail, consequent encroachment, that midpoint, you must always, every single time, without deviation, must take a partial. Always. It's in stone. Have it in your journal. Have it in your psyche. Expect it. Do it always. Then you have the buy side. Now, we're expanding, and I mentioned that cable could trade up into this area here because it's unfinished business. What levels above this buy side can we utilize? Well, I taught this, and I don't remember if it was in Twitter Spaces or if I think I did a live stream. I'm almost certain I did a live stream. At least I might be having a senior moment here. I believe I did it. I don't know. I'm second guessing myself now. But here is the gradient levels. I'm almost certain I did a live stream and mentioned this. But the low end of the gap, which is all the shaded area here, okay? Above this high, we have the low quarter percent, the lower quarter gradient level of this entire range. Then we have consequent approach, which is midpoint. We steam through that. So the next objective would be 127,754. That's a finite number. It's a static number. So if you were targeting that for another partial, you would factor in spread. So you would deduct whatever your typical spread is for your pound dollar forex pair, and then you would have a limit order sitting there. And if it were to expand up into that, you'd have a partial, and then there it is. If you're inclined to hold over the weekend and you feel like this is going to open up higher, which it could do, open up above it and trade down and fill in the gap. I'm playing devil's advocate for a moment, saying, and I don't know this because I'm talking to you as I'm watching it, but let's just say it meets the high of the day already here and it's done. We could gap open higher on Sunday and then trade down to this and fill the gap. And that would be a scenario if you're willing to hold over the weekend. I'm not trying to entice you if you're in it to do that. I'm just giving you scenarios how I would think about it. And when I was using over the weekend holds, when I would trade and hold positions from Friday's close into Sunday's opening, this idea I would use in this context here because this is still exposed. This is the other portion of that inefficiency on the weekly chart. Remember, all this movement from high to low, that shaded area, was one weekly candle where it only was going down. So to reprice efficiently, we're seeing price deliver on the upside. So until it gets up to this point here, there's an inefficiency in the form of a sell side imbalance, buy side inefficiency on that weekly chart. These are the parts where you get lost, and this is why it's important that you make sure that you rewind the video and scrub back to the parts where I actually show the weekly chart so you can remember what I'm showing you here. But it's important by having these higher time frame annotations on your weekly chart and then showing them on every time frame, you won't be surprised. You know, the things that generally have happened to you in the past probably won't be a issue for you when you start doing this. I'm trying to hit the delete button, but I was touching the page down. 50-year-old eyes. All right, so anyway, we're going to take a look at the 14th, how we traded in here, and then we'll drop into a 60-minute chart. All right, so here is the 14th at 2 o'clock. That's the beginning of what? London open kill zone. So the low, actually, prior to that, at 1 o'clock, that's the European Open. London open kill zone, 2 o'clock to 5 o'clock in the morning, New York local time. Then we gap up in here, rip off into, and then look at the bodies here. That's the low of that weekly imbalance, the fair value gap. That's the signature I like to see. When you start seeing moves form and they respect these higher time frame inefficiencies or areas where a real gap would be, or we're not talking about new week opening gaps today. We're not talking about new day opening gaps, by the way, in case you're wondering. But we're working with higher time frame weekly and daily inefficiencies. And this is the real support and resistance that you're looking for. Like one of the things that I tried to do was determine a way of picking what retail support resistance should be. And always, this is the one you use. I would always get them wrong. Sometimes I'd be right, but most of the time I'd get them wrong. So what I wanted to do was determine how I could bridge the gap between the expectancy of traders to see what is a support and what is a resistance and what qualifies and quantifies a support or resistance. And I found out that the largest degree of precision is around these inefficiencies. And anybody can say, oh, everybody's known about gaps. Everyone's known about, inefficiencies. But once they close in, they're done with them. I'm not. They're treasures to me. I'm holding on to them for months. And the algorithm will refer back to it, which is why I keep a 60-day look back on my charts. I'll go back 60 days in any old PD array, whether it be a fair value gap, a breaker, anything like that. I will refer to it if it's in the proper context of what I'm looking for. What does that mean? I stated on the 13th of June that I was bearish on dollar, and we would want to see the British pound trade up into all of this area here. That's the inefficiency from the weekly chart. It has